Hello there! So it's been a little while now since I've given you an update on EPR Properties. I know many of you follow this particular stock. One of the main questions I want to really address today is when will the dividend be returning? So we'll be looking at that. We've now got the 2020 annual report out. We've also got an updated February 2021 now investor presentation has come out. So I'm going to be looking at key points in that. Then I'll be looking at what the analysts are forecasting, as well as, of course, giving you my opinions, which so far I'm pleased to say have been going perfectly. So I'm quite chuffed with that. If you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving, and investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you get notified every time I release a new video. And if you enjoy this kind of content and find it useful, please do remember to give it a thumbs up, because that helps YouTube algorithm, which in turn helps me, and I do appreciate it. So let's dive straight into the slides. In fact, before we dive into slides, if you are unfamiliar with EPR Properties, please do check out my playlist, EPR Properties playlist. I'll put a link up there above and a link in the description down below, so you can check that out, because I explain all what EPR Properties do in those. I've analysed it to death. So this really is just a quick update video. I'm not going to be going through exactly what it does. In short, it's an experiential REIT. If you want to know more about that, like I say, watch my previous videos. There'll be a link in the description. This first slide here we're taking you through, I'm going to go through the annual report, just a few key parts of that I want to go through. So we've got the letter from the president. Dear fellow shareholder, we entered 2020 with tremendous optimism and a clear vision to build the premier experiential real estate portfolio. After a milestone year in 2019, where we announced our strategic focus to be a leader in experiential real estate, we were well positioned to accelerate our growth. However, our plans were quickly stalled as an unforeseen pandemic caused stay-at-home orders and forced social gatherings worldwide to cease. We, of course, know all about that. He goes on to say how they took swift actions, and if you look on the left-hand side there, you can see what their key swift actions were. The deferring of anticipated gaming revenue investment, which was approximately 1 billion, was deferred there. The deferring of other commitments and investment spending of approximately 600 million, and accessing their secured credit facility as a precautionary measure. They also suspended the monthly dividend to the common shareholders, which is exactly what we want to talk about today. And we're going to see a little bit more about dividends shortly. Now then, I want to just quickly draw your attention to that last paragraph here. While many of our properties are still impacted by the locally mandated closures and capacity constraints, performance and consumer demand continues to improve. Cash collections have increased materially from collecting only 29% of pre-COVID contractual cash revenue in the second quarter to 46% in the fourth quarter. Bear in mind, this is 2020 we're talking about, and more than 60% in the first months of 2021. So you can see 2021 is well up on 2020, but still they're only collecting 60% of their cash that is owed there, which obviously is not a good thing in my view. So on this page they talk about a return to normality. Again, I think the key section is actually the last little part here. You can put the positive trajectory and our substantial liquidity gave us confidence in our decision subsequent to year end to pay down our 1 billion line of credit to 90 million, while still maintaining about 500 million of cash on hand. Now that's a good sign in my view, because they did extend the amount of cash they had. They've been able to pay that down, and yet they've still got a substantial amount of money on hand, over $500 million cash on hand, which is obviously very good indeed. But let's look at this last paragraph. Even though we generated positive cash flow in the fourth quarter and anticipated this trend will continue, we still believe it prudent to maintain this large reserve of cash as we return to normality. The key thing there is positive cash flow in the fourth quarter. So that's good news. Even though in the first part of 2021, they've only collected 60% of what they should have been collecting, they actually were positive in the last quarter of 2020, which tells me there's still positive cash flow in the first quarter of 2020. And that's a good thing. And that's probably a part of the reason why the share price has rocketed in the way that it has, which we'll look at in a moment when we come to share price. First, I want to move on to the investor presentation and just go through a few key points from that. So of course, they want to give you the COVID update. So collections and deferral agreements. Q4 collections were 46% of pre-COVID contractual cash revenue compared to Q3 at 43% and Q2 at 29%. So it's moved in the right direction. January, this is January 2021 collections, were 66%, where February collections as of the 24th of February were 64%. So that is moving in the right direction. Deferral agreements have addressed approximately 95% of pre-COVID contractual cash revenue, granted 5% of permanent rent and interest deductions. Now, if you've seen my earlier videos, this is something we spoke about in those. So they've actually given up 5%. So of what was pre-agreed in the pre-contractual contracts. So essentially they've written off some rent there, basically, is what's happened there, which obviously is not a good thing from a landlord's point of view. It's not something a landlord should really be looking to do, but in this particular instance, I think they've had no choice, really. It was better than seeing some of their tenants go out of business and have nothing. So that, I think, is what's happened there. Now, property reopenings. Now, notice it's critical. They mentioned theatres first. We're going to come on to what proportion that takes up in a moment. But theatres, 60% of theatres are open. With vaccine rollout, major releases will accelerate in the back half of 2021. Now, that's a key important point there they're making. They really are emphasising a lot to happen in the back end of 2021. They're expecting that things will basically open up, and as you see around the world, they have started to open up already, but I think they're really banking on the back end of 2021 being where people really do get out again properly, so to speak, and that's when this company should start to thrive. At least that's what they're anticipating. But, you know, time will tell if that happens. Non-theatre properties, 94% of non-theatre properties are open. Return to growth. Key requirements: improve and stabilise cash collections, exit existing debt covenant waivers, reinstitute the monthly common dividend, and reinitiate investment spending. So that's a key point there. They actually have put there in their investor presentation, they want to reinstitute their monthly dividend. So it's going to be monthly. We know that now. They've said that it's going to be monthly again, like it was prior. So that's, I'd say, good for those of us who like a monthly dividend. And they have committed that that's something they want to do. So then if you have a look at the last paragraph there, they say when they anticipate that happening, and they've put, they're optimistic these goals are achievable during the second half of 2021. But obviously they caution that that's dependent on many variables, including an effective vaccine rollout. And that's the problem they've got here as this company goes. They're not really in complete control of if their clients are allowed to open or not. And obviously that's an important thing. If the clients are not allowed to open, they can't necessarily expect them to be able to pay their full rent, and that in turn would hurt EPR Properties. We'll talk more about that in a moment. McKinsey Company said as consumer confidence returns, so will spending, with revenge shopping sweeping through sectors as pent-up demand is unleashed. The bounce back will therefore likely emphasise those businesses, particularly the ones that have a communal element, such as restaurants and entertainment venues. The reason they're pointing this out, this is exactly the kind of thing that EPR Properties invest in. And what is their portfolio? I've brought this slide up so you can see 47% is in theatres, 26% is in eat and play, 8% is in ski attractions, 7% is in other attractions, 4% is in experiential lodgings. They look super cool, I will say, if I do say so myself. 1% is in gaming, I'd like to see that grow. 1% is in cultural, and 1% is in fitness and wellness. I'd like to see that sector grow as well. I've said in the past, I think they're too heavily exposed on the theatre side, and that really is what pulled the share price down, and that's what's keeping it down at the moment. We've got talks that AMC may well look to renegotiate leases and renegotiate their debts. AMC, if you recall, have had some major issues. Now then, if that happens at some point in 2021, you can expect that to affect the EPR share price in a negative way, by the way, and especially if they successfully negotiate rent reductions, because if AMC Properties do that, they are one of EPR Properties' biggest tenants, then what's to stop other cinema chains also doing the same kind of thing, which would essentially mean that the revenue that EPR Properties brings in could potentially be reduced for certainly a period of time. And if it's reduced, then obviously you can expect the profit to be reduced, and if the profit is reduced, you can expect the dividend to be reduced. And as this is a share that people tend to invest in for a cash flow, you need that dividend to be high in order for the share price to be high. So that would in turn keep the share price depressed. So I hope that made sense to you there. But let's now have a little look at the share price, which, by the way, already has gone past the $50. It's come back down now, but if you saw my previous video, which was the one in September, which was the EPR Properties stock analysis, I'll put a link up there and in the description down below to that specific videos. You'll see in that video I actually made predictions, and in there I predicted that by 2023 and 2025 we'd probably see a share price of between $50 and $72 per share. Well, it's 2021, we already passed it, so it's happened a lot faster than I anticipated. However, you know, to get to the $72 that I predicted, we've still got time, and I've still got a couple of years to wait for that as well, because bear in mind I did say 2023, 2025. which again, if you look in that video, you'll see my reasoning for all that. But looking back at that video, it's spooky how accurate I've been so far. So I'm actually very pleased with that. And obviously, if you were buying at the prices that I was recommending you buy at that point in time and that I was buying at, then you too will be well up as I am. Now at this point I should mention I am not a financial advisor, so this is not financial advice. You need to do your own due diligence and research before investing in any stocks and shares. But of course I am happy to share with you what I am personally doing, and as you can see so far we're doing great, folks. Let's have a little look at the forecast and then we'll have a look at the share price. So this is what the analysts are forecasting. So the 12-month forecast is now $41, and that's the high and that's the low. So whichever way you cut it, they are predicting the share price to go down over the next 12 months. So the analysts what is known as bearish on this, bearish meaning they expect it to go down. So that's what the analysts are saying over the next 12 months. And let's have a look at the share chart and see what we think ourselves, shall we? So here's the long-term share chart of EPR Properties. You can see back in the day, a long time ago, it used to hover in the teens. Now then, if we go back just to 2019, you can see it peaked at just under $80 per share. Okay, now obviously it had a massive drop in March 2020. And if you recall, I was really talking heavily about buying it and was indeed buying in October 2020 on this second dip, because it was fairly apparent to me that this was a temporary situation, and obviously up it's gone. Now then, is there room to go up further? Well, looking at its previous high, I think it's fair to argue it is. However, you've got to bear in mind, if it doesn't get the same rents as it used to have before, then you can expect that previous high to be lower, maybe somewhere around the $60 mark rather than around the $72 mark. But by 2025, I see no reason at all why there shouldn't be a $72 share still, just like I said in my EPR stock analysis video previously, because that's 4 years away, and believe me, people have a very short memory. My prediction is still that the world will open up, and when it does, and returns to some kind of normality, people will want to get out and about. Now, one of the things that could slow things down, like I say, are the theatres. If the theatres start negotiating rent reductions, or if the theatre industry in general gets in trouble, that will affect EPR Properties. I personally would like EPR Properties to diversify somewhat and to go more into other types of experiential real estate rather than just theatres, which currently takes up, as we saw, 47% of their income. So that's what I would hope for them to see, and I fully expect that they probably will, because this whole pandemic has really shown just how dependent on that they are. And I think, embarrassingly so, they don't want to be so dependent on one particular sector, and so are looking to change that, is my opinion. I mean, they've not said it, but that's my opinion, and we'll see what happens, won't we, in the future. If they do or don't, time will tell if I'm right there too. So now let's look at the 1 year chart. So if you just look at the past year, you can see it's been somewhat of a roller coaster ride. We've had the highs, we've had the lows, and it's currently on a relative high, quite honestly, which really, if you're the analyst, you can see the analysts are expecting it to be about the $41 mark. That's about there where I've put that pointer on the screen. So that's where they're expecting it to pull back to. It may not, who knows at all. Am I buying it or am I not is going to be one of your questions. Let's look at the 5 year chart. You can see previously it used to always hover for a good 4 years there. It was hovering between $65. It went to a low there of $53 and a high of just under $80, and we're currently just under $50. So am I looking to buy more shares in EPR Properties? No, not personally at the moment, I'm not. Now, would I be considering it if I didn't own any shares in it at all already? Yes, I probably would, in all fairness. But at the moment, I own enough shares in EPR Properties. Personally, I'd probably wait for a little pullback. But again, if it's something you are thinking of holding long term, if it's a company you particularly like, then I see nothing wrong with going for it. The price now is probably a good price, certainly if we look back at it in 10 years time. If, however, you're looking for a short-term investment, terrible. Quite frankly, the odds on it going up quickly are probably 50-50. It really could go either way. It's just depending on news. You get a little bit of good news, it'll go up. You get a little bit of bad news, it'll go down, just like any other share. So it's not something I would personally be buying myself, but the reason is because I have already bought lots of it and already own all the EPR shares that I really need to own, and I have them at a very good price. My cost base average. In one account is $27 per share, and in another account is $35 per share. Now, if the share price suddenly dipped down below $35 per share, yeah, I'd consider buying a few more, no problem at all. I'm very intrigued to see what happens when the dividend is reinstated, which, as we've looked at, is likely to be the back half of 2021. At that point, I do expect the share price to increase. If you are thinking of buying this particular stock, I would potentially say wait for the dips. If there are any dips, say under $45, consider it. If it goes down below $40, consider it more. If it gets into the 30s, that's when you really would be thinking your best time to buy, I would say. It's unlikely to go lower than that. However, watch what happens in the theatre industry as well. If the theatres get in trouble, then this share will go down. And if it does, that potentially is a good time to buy. Although bear in mind, if there's a genuine issue and them tenants go out of business, that will also have a real impact on the business model of EPR Properties, which is why you don't want this as a staple, as your main holding in any stock portfolio, in my opinion, and which is why it's only a relatively small part of my opinion and why I'm not really looking to buy any more shares in it myself. That said, I do expect I'm going to make very good money on it. I've already made very good money on it. It's almost doubled since I started purchasing it, and I believe it will go further. And I also believe that once that dividend is reinstated, it will go up more, and of course then I'll have a nice dividend income, and I'm quite certain when I come back and look at this in 10 years time, I'll be very happy with my investment. Anyway, I hope you found that useful. Thank you so much for watching. Please do remember to hit that thumbs up, and bye bye.